Hello there, small business owners. Today we're diving into a crucial topic that's essential for anyone considering a sale of their business, valuing your small business. So let's get started. When it comes to determining the value of your small business, there are several methods to consider. Each method offers a unique perspective, so let's take a look. First up, we have the asset-based valuation method. This involves assessing the total value of your business's assets, such as equipment, inventory, and real estate. Subtracting liabilities gives you the net asset value, a solid approach for businesses with substantial physical assets. The asset-based valuation approach is a method used to determine the value of small businesses by focusing on the value of their tangible and intangible assets rather than relying solely on income or market comparisons. This approach is particularly useful when a company's earnings potential is uncertain or when it holds significant assets, such as real estate or valuable equipment. The primary purpose of asset-based valuation is to establish a minimum value for the business, ensuring that the value of its assets is adequately considered in the valuation process. Let's look at some of the pros using the asset-based valuation. First, this method provides a clear recognition of the value of a company's tangible assets, which can be especially relevant for businesses with substantial physical resources. Second, asset-based valuation is beneficial for assessing a company's financial stability and determining the liquidation value in case of bankruptcy or dissolution. And lastly, the approach can be relatively straightforward, especially when compared with more complex methods like discounted cash flow method. Let's talk about the cons of using the asset-based valuation approach. This method tends to overlook the value of intangible assets like brand reputation, intellectual property, and customer relationships, which can significantly impact a business's overall value. Additionally, asset-based valuation doesn't account for a company's potential future earnings, making it less suitable for businesses with strong growth prospects. Also, external market factors and fluctuations aren't directly factored into this approach, potentially leading to an inaccurate valuation during volatile economic conditions. And lastly, this approach might not capture the true value of a business if its assets' market value significantly differ from book values, potentially leading to an undervaluation or overvaluation. In summary, the asset-based valuation approach is valuable for determining the minimum value of small businesses with significant tangible assets or scenarios where income projections are uncertain. However, it should be used alongside other valuation methods to ensure a comprehensive and accurate assessment of a business's overall value. Next, we have the income approach. The income-based valuation approach is a method used to determine the value of a small business by assessing its future income-generating potential. This approach primarily involves calculating the present value of expected future cash flows, taking into consideration factors like projected earnings, growth rates, and risk factors. The income-based approach is especially beneficial when valuing businesses with stable and predictable income streams, as it provides a direct link between a company's financial performance and its valuation. It is particularly useful for service-based businesses, technology startups, and businesses with intangible assets that contribute significantly to their income. However, this approach might not be suitable for businesses with irregular or uncertain cash flows, as accurately projecting future earnings can be challenging in such cases. And additionally, it might not capture the full value of businesses heavily reliant on tangible assets, and adjustments for risk and discount rates require careful consideration to ensure an accurate valuation. Now let's talk about the market-based valuation approach. This approach involves determining the value of a small business by comparing it to similar businesses that have been sold or are currently on the market. This method relies on analyzing market data and recent transactions of comparable businesses to establish a valuation benchmark. The market-based approach is most appropriate when there's a robust market for similar businesses and sufficient data is available for comparison. It is particularly useful for industries with well-established market trends and where there is a consistent supply of transaction information. The benefits of this approach include its reliance on real-world market data, making it relatively straightforward and reflective of current market conditions. However, potential pitfalls include the challenge of finding truly comparable businesses, as each business is unique in its operation and circumstances. Additionally, market conditions can fluctuate, leading to variations in valuation based on timing and external economic factors. Careful consideration of the selection and adjustment of comparables, as well as accounting for any differences, is essential to ensure the accuracy of the valuation. Now, keep in mind that no single method is a one-size-fits-all solution. The value of your business can vary depending on which method you use. Many business owners choose to use a combination of these methods to arrive at a more accurate valuation. So how do you actually get started? Well, it's crucial to have accurate and up-to-date financial records. Your income statements, balance sheets, and cash flow projections should be in tip-top shape. And remember, potential buyers will likely conduct their due diligence, scrutinizing every aspect of your business. So it's best to be prepared with all the necessary documentation. Wrapping up, Valuing your small business is a nuanced process, and it's highly recommended to consult with financial experts or business valuation professionals. They can guide you through the complexities and help you arrive at a realistic and fair valuation. That's a wrap on valuing your small business, folks. Remember, understanding your business's worth is a critical step in your journey towards a successful sale. Until next time, keep those entrepreneurial spirits high. If you are a small business owner and want us to provide you a complimentary business valuation, give us a call at the number below. Thank you for joining me today. Don't forget to hit that subscribe button so you never miss any valuable insights and updates. I look forward to being your partner in success. See you in the next video.